Hi everybody, I'm David Huff, CPA, PFS, Masters of Science in Taxation with DW Huff Consulting. So somewhat of a quiet week, not a lot going on, deadlines and such. However, the first thing I noticed that I wanted to, I guess, bring to everyone's attention is this crackdown on fraudulent tax credits. So what brought this to my attention is earlier in the week there was this news story about this IRS processing center in Detroit, Michigan. And there was these lines of people out there, I mean, blocks long. I forget, it was a few hundred people if I remember correctly. And what had happened was these taxpayers that filed tax returns, all of them were getting big refunds. And they were flagged as being fraudulent to the fact that it was so high, the dollar amounts were so high, the IRS was concerned about identity theft. So in order for these people to have a chance at getting their refunds, they had to come in and prove their identity. So that seemed kind of bad, right? If it's just an identity theft problem, you know. But what it turned out to be was whether it was via TikTok or just some unscrupulous tax preparer, a very large number of taxpayers that were covered by this one particular service center had these insanely high amounts of these credits, like for fuel tax credits, family leave credit, and household employment taxes, which is, those are three that aren't really common, outside of certain type of small business owners and things of that nature. So the fact that these people that had just W-2s and small amounts of income were claiming large amounts of, five-figure credits in some cases, threw off a lot of flags. And now it's a huge inconvenience because now these people had to wait in line to prove their identity, and then while they're at it, the IRS is going over the return in a little more detail, asking naturally for more documentation and backup for things that wasn't available. So now these people are filing amended returns when they thought they were getting $40,000. Now it turns out they're getting $400, and having to file amended returns. So so this, I guess, the news article as it was first presented ended up being inaccurate. So it really was more a matter of these overly abused tax credits being claimed on a large number of returns that caused this need for the IRS to actually just say, okay, stop, come in, prove who you are, prove your numbers, or we're not giving you the refunds. So things aren't always what they seem. So anyway, be careful. Like I always say, that the TikTok stuff, it always can get you in trouble. It seems like, because there's always a lot of missing pieces to those clips as far as the information goes. So, all right. So on our normal stuff, weekly observation. So I'm talking a lot about clients about tax planning now. We know some of the tax provisions that have been in place since 2016 are going to expire for the 2026 tax year, and that causes us to kind of think through a few things here. Comparing current year tax rates to what's going to be projected. So prior to this Tax Cut and Jobs Act of 2016, the rates were, what they're going back to here on the right-hand column, with the 7 brackets, lowest being 10, highest being 39.6. So currently it's 10 and it goes up to 37. And our standard deduction is going to change. So as it is now, $14,006, and I mean $29,200 for the married filing joint, and no personal exemptions. That's going to switch back to the old way of calculating things, where that married person is going to get a $16,000 standard deduction, and each individual gets a personal exemption of $53,000. So smaller families are going to notice they have a lot more taxable income right out the gate. So so the higher tax brackets and the lower standard deduction is a big planning component as far as our calculation goes. But another thing to look at is the difference in where the tax brackets start. So currently, currently this bottom section shows the rates, the way the brackets fall now compared to how it's gonna be. So a married filing joint taxpayer is first, a dollar above, his standard deduction exemption, gets taxed at 10%, and the next $18,650 is taxed at 10%. So that's bad, because as it is now, that bracket stops at 23,000%. So you're going to be getting into the 15% bracket faster than before. Also keep in mind that currently the next bracket up is only 12%, versus that 12% is going to now be 15%. So it's a higher bracket for most people, and it starts at a lower taxable income amount. So yeah, so when you look at the compression of the tax brackets, for one, the fact that the brackets as a whole are higher, we can see much higher tax brackets, tax bills come up in our future. So the reason why this comes up is we're always thinking about Roth conversions and retirement plan distributions, and the general rule is you kick the can down the road as far as you can, and just avoid it. But these are pretty substantial increases in tax. So assuming nothing changes and everything falls out as it's projected to, how it's projected to look, you could be taking a big tax hit. So in that scenario, that's I guess an exception to our normal rule, and we'd want to probably look at some things. And if we were considering a Roth conversion, or maybe just pulling some money out of a qualified retirement plan, taking a tax hit now at what looks like it's going to be a very reduced amount compared to 2026, so we have less to deal with in the future. And not only the Roth IRA conversion, but sometimes just when you're thinking down the line a little bit for those required minimum distributions in the future. So once you get to be past a certain age, they force you to take money out of a 401k. So if the balance is high, it's going to be a higher dollar amount, obviously, taxed at this higher rate. So sometimes you want to look at finding ways to reduce the balance in those accounts that have deferred taxes into the current year, so we pay a little bit lower rate and then do something else with them with a regular taxable account, Roth conversion, etc. So we see for sure within the near future how brackets are going to get higher and things are going to get a lot worse, assuming there are no changes. And with the political landscape and that whole thing with the election, we're watching it closely because it's hard to really guess, but it would appear that tax brackets are going to be going up. All right. Also had a discussion with a bunch of people about the housing market. So we know a lot of our clients invest in real estate, and there's a lot of talk about this housing market crash, right? So Jason Hartman on his podcast mentions it frequently because it is on everybody's mind. He is of the opinion that it's probably not going to be as bad as prior crashes, mostly being the one in 2008 is the most recent one that most people can remember. But there's reasons why it's different this go around, and we don't see the potential fallout being as bad. So one of his slides here shows how comparing current mortgage holders to 2008. We look at them. There's a lot higher credit score, so it's not a lot less of I guess lower rated mortgage debt out there, because most a very high amount of this stuff is people with credit scores of 760 or higher, very good credit score, right? And all these people have a lot of equity in their houses as well. So now we're looking at $299,000 worth of equity that's tappable. So I'm sorry, 193, which is tappable via home equity loans and that kind of thing. So yeah, because they mentioned maintaining that 20% equity stake. So the fact that these people won't be forced out of their house, so if something bad happens and the economy takes a hit and slows down really bad, the odds of them being underwater in a mortgage and having to sell or get foreclosed on is a lot lower when you have this much equity. They can always refinance, pull cash out to deal with that debt, and kick the can down the road a bit and survive. So that was definitely not the case in prior mortgages. So they show here, as it is now, the amount of people that had low credit scores. So that bar graph you're seeing here is the people who qualify with mortgages, 660 and below. And you go all the way back to 2003 here and see how obviously it dropped off big time after the crisis hit. But now in current conditions, it's low. So there's very few people that have weaker credit profiles getting approved mortgages. So, based on that and the fact there's a lot more equities across the board, it's not looking as dire of a situation. So the fact that interest rates are kind of high, some sales are moving slower, and I guess there's not as much activity as most investors would like in the market. It's not necessarily a precursor to something really bad happening. So check out Mr. Hartman's stuff there. I watch his podcast regularly and find it all to be pretty useful. So that's it. So with that, closing thoughts for the week here. I have read this quote from Kurt Vonnegut. We are what we pretend to be, so we must be careful about what we pretend to be. So I don't know, fake it till you make it. Trick yourself into thinking things are good so that you'll make things good is the takeaway there. And the reason why I'm into Kurt Vonnegut now, I just started reading Slaughterhouse-Five. Kind of a dark portrayal. This guy who wrote this book was a World War II veteran who was a prisoner of war for a period of time. It kind of jumps around a little bit backwards and forwards in time based on his experiences in World War II. And I just started reading this. I can't really comment much, but what I've learned about the author makes me very excited about this book and that little bit of wisdom I shared with you. So that's it for this week, guys. We'll see you next week, and y'all have a great weekend.
Yeah.